where we're featuring Dyches Boddiford, and he's going to be talking about using self-directed retirement accounts basically as a tool in your tool belt. So a lot of times here at Advana, we talk about how you can make investments with your own retirement, but oftentimes we are dealing with people that use us as a tool and sort of guide their investors into using retirement accounts to make those investments so that they get better returns. It's growing tax deferred and tax free. Of course, also retirement accounts tend to be more liquid. So when you have an investor working with you on a regular basis and they say, I'd love to participate in that deal, but unfortunately all of my money is out in other deals at this time, knowing and understanding a little bit about self-directed IRAs can go a long way with the people that you work with on a regular basis. And so in just a few minutes, I'm going to introduce Dyches, and he's going to talk about deals that he's used other people's retirement accounts for and how it's worked out for both parties. But I'm going to start out with just introducing you to Advanta IRA and how we work. And then, of course, I want to invite you to join us for any number of webinars that we have. We have them every week. They're always no cost, no obligation. And there's a lot of us here at Advana that educate, and so you're always getting new and different viewpoints from what we're experiencing out there in the marketplace where we're located. So my name is Larissa Green. I've been with Advanta IRA for almost 9 years now, and I've always been involved in every different part of the business. And so I've been doing marketing and business development for probably about 7 years, but prior to that I did check coding, new accounts, I've done transfers and transactions, and so I'm very familiar with what we do here on a daily basis. And I'm located here in our Largo, Florida office, but just so that you're aware, we're also in Atlanta, Georgia, but we can work with anybody anywhere. And so we have clients nationwide and even worldwide, because we have clients that live abroad that have US-based retirement accounts, and so they're using those accounts to self-direct as well. Advana IRA has been doing this since 2004. We only handle qualified funds, so that's very important. We can't help you place funds that are considered personal money. And also, we really don't help you place funds anyway. Our role here at Advanta is to hold the account, act as your third party per IRS rules, and then you go out there and find the investment. So that's very important for you to understand. We don't sell any investments at all. What we do is act as the third party that will handle record keeping for those investments. So when you find an investment, you bring it to us. We help you get it titled properly in the name of the retirement account, and then we do the record keeping. So for example, if you lend money, we're going to receive the payments, deposit them to your account as interest and possibly principal payments. We'll help you do your annual reporting. And so the IRS requires that third party, and that's our role here. What we don't do is give legal, tax, or investment advice. And, I really like people to understand that your due diligence, it's all going to be up to you. And so if you come to me and say, hey, is this a good investment? I can't help you with that. I may be able to refer you to professionals that can look at the investment and help you understand what due diligence you may need to do. But Advana isn't here to give you legal, tax, or investment advice. You can always ask the question, and if I can't answer it, then I certainly could refer you to a professional that can help you with that. The number one reason people haven't heard of self-directed retirement accounts is just very simply because there's not a whole lot of people out there like Advanta willing to hold these accounts. So brokerage firms, Charles Schwab, Fidelity, Morgan Stanley, those are all great companies, but they've made it their business decision not to hold investments that they consider hard to value. They don't want to have fiduciary responsibility over those investments. And so we just sort of fill the gap in the industry. And on the reverse side of that, we've made it a business decision not to hold anything publicly traded. So I can help you hold real estate or invest in private companies, but I can't help you invest in stocks, bonds, and mutual funds that are traded on the market. So just keep that in mind. But also, this strategy is not all or nothing. It's a great way to diversify your account. And so you could hold something based in real estate, and then you can have your brokerage firm where you're trading publicly. So completely up to you, but just keeping in mind that you have to have that third-party administrator for those self-directed types of investments or alternative assets, as we like to call them. A lot of times when I meet people, they think that the IRA account that is self-directed is only a Roth IRA, and I'm really not sure where that comes from. Dyches, do you experience that a lot when you're talking to people about self-directed accounts?
Yes, that's a common thing that comes up.
And I'm not really sure where that comes from, maybe because the idea of the Roth where it grows tax-free, I don't know, maybe it has some basis in that, but it's important that you understand if it ends in IRA, it can be self-directed. So I like to say that because that really pretty much covers everything in the retirement world that people are most familiar with. But then also if you have an old employer plan, those can be self-directed too, and that's just a very easy rollover. And I emphasize old employer plan because typically you do have to sever ties with the employer before the administrator of that plan is willing to allow you to move funds. Every once in a while, I experience somebody that maybe works for a larger company or they've been there a certain amount of time or reached a certain age where they are allowed to roll funds, but it's not normal. That's not typical. Typically, you have to sever ties with the employer. You're no longer participating in that plan, and then you're eligible to move it into an IRA and therefore self-direct. Another plan that I have up here that, I really like to point out, especially to many of you who are on this call, very likely are going to be self-employed. So solo 401k, it's a great account. We can help you with those. And, if you're really looking to not only maximize your contributions, but also have easy checkbook control of that account, a solo 401k may be something you want to learn more about. And I know Dyches is going to talk about the self-directed class he has coming up on March 28th and 29th, and they talk a lot about solo 401ks there. And so I'm going to let Dyches talk about that also in just a few minutes. But, if you guys like what you hear and you want to learn more, I strongly suggest you go to his website and check out the class because that's coming up shortly here, very quickly, as a matter of fact. And then also up here, I have education savings accounts and health savings accounts. And I know that they're not retirement accounts, but because the rules for self-directing those accounts are going to be exactly the same as the retirement accounts, we can hold those as well. And I know interest is really going up in health savings accounts. There's a big advantage, tax advantage and savings advantage to having a health savings account. So we're seeing a lot more of those in recent years. And then education savings accounts, unfortunately, I don't see enough people utilizing those. And I think probably because, there's no deduction for making your contribution, and the contribution limit on an annual basis is only $2,000. I have no idea why they don't raise that, but that's probably why we just don't see as many people using those as investment vehicles. And I like to give everybody an idea of what we're seeing as far as investments go here at Advana IRA. So every year we run statistics, we see what our clients are investing in. And really, you would be surprised to know that it really is truly all over the place. Now, 30% of our investments, and we have about a little over $1 billion under management here at Advana, 30% of those assets are real estate or real estate based. So that is the bulk of our business. But it is important to us that everybody understand that with a self-directed retirement account, you can invest in what you know. And so if you're, uncomfortable with real estate, you don't understand it, but you understand investing in startup companies, for example, you can do that with a self-directed IRA. And so here on the screen, you can see a list of things that we see on a regular basis. Of course, any type of real estate, whether it's residential or commercial, rehabs and flips, we'll see. People might lend money like joint venturing, for example, mortgages, unsecured notes. I know that always surprises people as well, but remember, that might not be an investment that you or I are comfortable with, but there are a lot of people out there that are lending money to businesses, for example. And, I guess the greater the risk, the greater the reward, as they say. So we're seeing people do that as well. And again, making sure you're doing your due diligence, but if that's the investment that you feel comfortable with, then we can help you get it done. I have an example of joint venturing in just a minute, so you'll see how that works within a self-directed retirement account. But I also want to point out our other alternative assets list here, because I know some of these are very unique and, of course, less common than something like real estate. But we do see people invest in things like farm animals. And so, we have, I think sometimes we tend to forget when we're in a very large area, very heavily populated, that a lot of people are working out there in our communities as farmers. And so if that's something that they're familiar with, I had a cattle farmer call me and we talked about making investments. And of course, again, based on the rules, he'd have to be investing in a third party's cattle, but he certainly could make those investments. And so you'll see in that list, maybe again, some investments we consider truly unique, but the idea is that you're investing in what you know. So I just want to quickly go over this example of equity participation so that you can see what your role would be with a self-directed IRA, maybe what your borrower's role is, and then as well as what the administrator's role is. So in my example, Andrea belongs to a real estate club. She has $100,000 that she wants to lend out. And so she's going to look for a borrower. And so again, remember, Andrea's going to do due diligence on the borrower, who in this case is Steve, but she's also going to do her due diligence on the property. So Steve is going to give her, sort of what he believes will be the return on investment for this joint venture, but she's going to want to go out and look at the house and make sure that she agrees with his numbers and the turnout at the end. And so again, simple example, don't worry too much about the numbers, and Dyches is going to give us some real examples in just a few minutes, but she lends out $100,000. She might charge an interest rate of 5%. I know when I teach this and there are people sitting in front of me, they say, whoa, 5%, can I meet Andrea? But keep in mind that this is a joint venture project. So she's going to charge some interest rate, but she also wants a share of the profits or a share of the upside when the property is sold. So they agree to equity participation, 1/3 of the profits. It's a 2-year balloon note, so interest-only payments, and there's the monthly payment for you. And Andrea is happy because she gets a first mortgage on the property. So, the great thing about lending from your retirement account is you really do get to determine the rate at which your retirement account is going to grow. And so Andrea sort of laid out the numbers here for Steve, and they agreed because there's a benefit to both of them in this transaction. So they agree upon the terms. Andrea is actually going to sign all the documents read and approved because that's what Advanza requires, so that we can say, yes, these are the terms I'm agreeing to, please send the money. So we need her permission to send the funds based on this investment. And then once that's done, money will go through a title agent or a closing attorney and ultimately to Steve so that he can buy the property and do the rehab. When he is ready to pay off the note and he sells the property, he's going to call Andrea, let her know. They're going to work it out between them, and then Andrea is going to come to us and let us know that Steve is going to be paying the note back. Once that's done and the money comes back to Advanza, Andrea is ready to make her next investment. And then I like this slide because I really like to show basically both sides of this equation, again, using an IRA as a tool in your tool belt. So maybe Steve and Andrea knew each other prior, and he said, hey, did you know you could use an IRA, and then your gains are going to go back tax deferred or tax free? And so just having that knowledge may have helped him work with Andrea in this example. But the repaid principal was $100,000. She had $2,500 in earnings over the payments that he made over the course of 6 months, I believe it was. And then she got 1/3 of the profit. So if he sold the house at $130,000 and $30,000 in profits, she got $10,000. So her total earnings were $12,500. And then don't forget Steve, who made this deal with Andrea and also benefited from the deal. So he got his loan amount $100,000. He sold the house at $130,000. And the repayment plus points and interest was $12,500 for a total earnings for him for $17,500. So again, the numbers aren't important here, but just to give you an idea of how that structure works. And I want to make sure that everybody understands that while those payments are being made, those interest-only payments are being made, they're not being made to Andrea. That's very important. They're going back to Advanza for benefit of Andrea's IRA. And so we return those checks deposited to Andrea's IRA account as interest payments to the loan. And then once the money gets paid back, again, very important, the money is going to come back directly to Advanza IRA. And then again, when Andrea is ready, she finds her next investment and she's ready to go. I had a question pop up. Is it borrowed money taxable in an IRA? So that's a great question. And I think the structure of the question, you're really more asking about financing in an IRA. So keep in mind, you can't borrow from an IRA. And this investment is not a loan to the account holder. It is an investment under the IRA. And I think sometimes what happens is when we think about IRA investments, we consider stocks, bonds, and mutual funds. And that's just very common in an IRA account. We don't consider how those assets are titled. But in this investment, this note is titled as an investment of the IRA. So it's not a loan. And as far as Andrea taking a loan to make the investment, it is a note to Steve. But if you are financing in an IRA, that's a different scenario. So if you buy a rental property, for example, and you use financing to buy it, in the IRA account, it is subject to tax. So that's a great question. I'm not going to talk about that on this webinar, but if you have more questions, please reach out to me directly. And so with that, I'm going to introduce Dyches Boddiford. Dyches, thank you so much for joining us today.
Well, thank you, Larissa. I appreciate the introduction, and I enjoyed your little presentation there. We'll cover some of the issues in our discussion here on the financing. So let's go ahead and get to it, because I got a bunch of slides and not a lot of time. All right. What must you know to invest IRAs or solo 401ks in real estate? There's some things that you absolutely need to be educated on before you start doing this. For instance, you must know the rules, the investment rules, the disqualified party rules. These are all something that you must be very familiar with before you start trying to use either your own IRA or solo 401k or others' IRA or solo 401k in doing deals. You can't receive money personally from a deal that involves your or a related party's IRA or 401k. So a related party is like your spouse, your lineal descendants, or ancestors, or any entity that you own 50% or more of. There's some others that are included in this. That's all part of knowing the rules. But with if you are involved in the transaction personally, you cannot get money out of the deal if it's your IRA or a related party's IRA or a solo 401k that's invested in the deal. So if you're going to be involved personally in a deal, it needs to be a non-disqualified person's IRA or solo 401k. You must use a true self-directed custodian, such as Avanta, to do these deals, because that custodian is charged under the IRS requirements as the one that holds the funds and also holds the titling to the investments. In the case of a note and mortgage, they will hold the original note and a recorded copy of the mortgage itself. Don't forget rule number 1, which is probably the most important of all the rules, and that is you must know the rules. Now, I think, Larissa, y'all have got several other webinars that go over the rules, right?
We do, absolutely.
That's good. All right. Well, what are those rules? Well, it's what investments are allowed in the IRA. This is an easy one to answer. It's pretty much any kind of investment except insurance can't be held in an IRA. The certain kinds of collectibles cannot be held. Gold bullion can, but numeristic coins cannot. So there's a lot of things that you need to know. Who are the disqualified parties? Well, generally that's going to be you, any business you own 50% or more of, or any business that your lineal descendants, their spouses and ancestors might own 50% or more of, or those persons individually. What are prohibited transactions? Now, this is a long discussion that we have in our class about using IRA funds, whether it's yours or someone else's. You've got to know what the IRS says are prohibited transactions, because the penalties are onerous. It can blow up your whole account as of January 1st of the year in which a prohibited transaction occurs. And it could be 4 or 5 years after the fact when it's discovered that you have a prohibited transaction. And you need to know about unrelated business taxable income issues, which we'll talk about next. Unrelated business income tax is something that a lot of people are confused on. They're saying, well, an IRA doesn't have a tax ongoing when you're just doing deals. Well, it could. If it meets certain requirements or certain guidelines, then there is going to be a 990T required, which is unrelated business income tax. It is where the account has income from an unrelated trade or business. For an IRA or solo 401k, that means most any ongoing business activity, such as flipping property or buying and selling notes and mortgages on a regular and substantial basis. If the IRA or 401k holds assets with financing, you can have unrelated business taxable income. There is an exception for a 401k, not an IRA, but for a 401k that buys property that is going to hold for investment, such as a rental property, and there is acquisition financing on the property. That does not have unrelated business income tax associated with it. But you got to be very careful about it, because let's say you buy a property, you've got plenty of money in your 401k, and you buy the property for all cash, no problem. And then a year or two goes down the road and you decide, hey, I can pull some money out of that asset to use for further investments and leverage my account a little bit. That is not acquisition financing. If you do that, it is going to be subject to unrelated business income tax. And thirdly, you have unrelated business income tax if you receive rent, or I should say your 401k or IRA receives rent on personal property. Now, understand what's so bad about unrelated business income tax is that it hits 37% at just $12,950 in profits. So it can be a very high rate. And if it's in a traditional IRA, that traditional IRA money is going to get taxed again when it's finally distributed out to you or your heirs. So be very careful about unrelated business income tax. All right. Let's talk about the kinds of investments that you can make in the real estate area with your IRAs or 401ks or other people's IRAs or 401ks. The choices are quick turn properties. These are properties that are bought and with the intent to fix up, or not even fix up, just resell in a relatively short period of time. There is no definitive rule under the IRS code about what quick turn properties are or what is considered dealer properties. But it's generally accepted that if you do a continuous business of flipping properties in your retirement plan, that is going to be subject to the unrelated business income tax that we just talked about. So be careful with the quick turn properties. If you only do one in there that's a quick turn property, that is not continuous and substantial under the definition of doing business. So you might be fine. But how many more can you do in there? No one knows. We haven't seen any tax court cases that can actually answer that question. Investment properties are something that a lot of IRA owners and solo 401k owners that have self-directed accounts like to invest in. We'll talk about pros and cons in a minute. Thirdly, we might invest in, if I can get this, there we go, notes and mortgages. Now, this is my favorite way of investing IRA and 401k funds. This can be loans that you actually make to third parties, or from your IRA or 401k, or it might be notes and mortgages that are purchased at a discount. Now, if you loan money and immediately turn around and sell the note and mortgage, then you may be back over into the brokerage and a situation where you're running a business inside of your IRA or 401k, which makes it subject to that unrelated business income tax. So be very careful about that. All my notes and mortgages, both the discounted ones that I purchased and the loans that I've made, I hold until the maturity of that note and mortgage. Pure options are another type of investment that we make with funds from solo 401ks or IRAs. And you can use other people's money to do that with. We'll look at an example as we go on here. All right, advantages of each one of these. Quick turn property generates quick cash, can help build an account quickly. But the disadvantages are that it's exposed, that the retirement plan itself is exposed to liabilities from the property since it is the owner of the property. There's things we can do to mitigate that, but just remember that that is one of the issues that you need to address. It's considered a business by the IRS if it's regularly carried on, requiring unrelated business income tax return. That's the 990T referred to earlier. The purchase must be an all-cash purchase, or if there is financing, it must be non-recourse. That's really important. And in Larissa's example earlier, where the lady had made the loan to the investor, that had to be non-recourse. In other words, if he defaulted, she could go after the asset that was collateralizing the loan, but she couldn't go after the whole IRA account, or excuse me, he couldn't go after, well, you see what I'm getting at, that it has to be a non-recourse loan. And an unrelated business income tax return may be required if there's non-acquisition financing in the 401k and all financing in the IRA. And by the way, there is an exemption for the first $1,000 that is earned in a transaction from the unrelated business income tax. But you do have to calculate every year exactly what the net income is from the transaction.
And I just want to point something out about that, Dykes, that I always think people find very interesting is that I probably talk about purchasing property using financing with individuals who call Advanta 5 times a week. But the truth of it is 99% of people who buy property with an IRA are using cash. And
Yeah.
I don't think it's a difficult strategy, but I like to say that there's a lot of moving parts there. So, what you want to do is find an accountant who can help you run the calculation for unrelated debt financing or business income tax so that
Right.
you can really understand it and make sure that it works for you. Another moving part is the non-recourse loan. And you're not going to find a ton, especially institutional lenders, a ton of institutional lenders, I should say, that are going to be willing to lend on a non-recourse basis.
And also, if you do find an institution, which I know of a couple, they want 40 or to 50% loan to value ratio. I think the highest I've heard recently is 55% loan to value loan that they'll put on the property. So just to be aware of that. The investment property advantages can generate a steady cash flow. It appreciates over time. Disadvantages are the retirement plan is exposed to liabilities from the property, as we said earlier. And let's see, got to get back to my clicker here. It must be an all cash purchase, or if there is financing, it must be non-recourse, and an unrelated business income tax will be required unless there's the 401k exception that we discussed a little earlier. All right, for notes and mortgages, this is my favorite one. The advantage is it requires little time to initiate, it generates steady cash flow, and it can be very safe. Notes and mortgages do not incur much liability whatsoever. Disadvantages, well, relatively slow account growth. But don't discount this because relatively slow account growth can still be quite significant when there's no income tax. All right, options. Options take very little cash, so a lot of people are attracted to them because of that. And they can generate huge returns if they're real options now. There are a lot of sham options out there that the IRS will not accept as a true option, pure option. But if it is a true option, it can generate huge returns still. The disadvantage is it requires more sophisticated parties that understand what an option is and what their obligations and rights and responsibilities are. So you're going to have to deal in options, not with the just regular old homeowner. You probably need to deal with other real estate investors in order to get the options and exercise them. All right, I got some examples I'm going to show you. I've rounded off some of the numbers, but these are deals that I've seen I have done both myself and have seen others do over the years. Let's look at a straight loan deal to start with. This is probably the best kind of investment you can make if you're just beginning to self-direct your accounts. You find a house that when fixed up will be worth at least $120,000. You're able to negotiate an all cash purchase price of $70,000, but the house needs $14,000 in fix up. You want to flip the house and approach an IRA account holder to borrow the money. They happen to have $84,000 in their self-directed IRA account and they decide it's a good deal. That little phrase that they decide it's a good deal is really important. in the process of doing due diligence, both for the investor and the lender in this example, they need to both decide that this is a good deal, and the lender needs to feel like it's a deal that they wish they had found and invested in themselves, rather than just being a lender on the deal. In this case, I'm the one that had found the house, or you in the example here, and I need that money from the lending party. So how are we structured? You offer to borrow the $84,000 at 8% monthly payments of interest only for 6 months, then the full repayment is due. The IRA account holder directs the custodian to send $84,000 from their IRA to the closing attorney. By the way, you should always use a closing attorney or title company anytime that you do transactions with real estate, whether it's inside of your retirement account or outside of the retirement account. They're the only ones that have errors and omissions insurance and can get you title policies. The attorney prepares a mortgage and note. Monthly payments will be $506, that's the interest only, and a balloon at the end of 6 months in the amount of $84,560. So let's say it goes the full 6 months. There's no points in the example we just had here. The monthly payments for 6 months total $3,360 in earnings for the IRA account on the $84,000 loan. That is a cheap source of money for quick turns, while the IRA account earns more than it normally would otherwise. 8% is a pretty good return in today's marketplace, but we can do better. Where do you find people that will invest their IRA or solo 401k with you? Well, personal friends, financial friends, some family. We got to be careful of disqualified parties. Local RIAs, where there are new investors and seasoned investors. There's a lot of new investors that have money in retirement accounts. They've left their old workplace, or there are other entrepreneurs as well that have solo 401ks and IRAs. And they're seasoned investors that have gotten to the point now that they just want to invest their funds rather than having to go out there and buy property and fix it up and rent it out and go through all the process of maintaining property. They'd rather just get the monthly collection on the notes. Courthouse records, you can find people that have loaned their retirement funds to others, someone that you can contact. You might find someone that has in the past been involved in a loan or a transaction where an IRA was involved, and that IRA might now be looking for other people to invest with. Of course, referrals, coming to webinars such as this and events such as what Advanta has, some of their free lunch events, and classes like the ones that I put on with Pete Fortunato and other people. You can find people that might refer you to somebody that has a good size account that might be looking for a way to invest. But do not advertise for lenders. If you advertise for lenders, it could be determined that you're offering a security. This has happened in several states over the years. So you need to deal with people, friends and family, the people that you know, people you already have a relationship with, not the general public. So don't put any ads in the newspaper looking for loans or looking for funds to invest. That's considered security in most states. Build a list of people and the terms that they will take, so that anytime you have a potential deal coming up, you know who you can call to see if they still have funds available and if they're still willing to loan at a particular interest rate that you had discussed with them in the past. You may need to educate them and suggest true self-directed custodians such as Advanta, where they can move their accounts if they don't already have a self-directed account. All right, here's the second mortgage example. You found a house that when fixed up would be worth at least $80,000. You also have been able to negotiate a purchase price of $50,000 with $5,000 down and seller carryback financing at 10%. Interest only, monthly payments with a balloon in 6 months. The house needs $5,000 and fix up for carpet and paint, so forth. Now, this is a case where you may want to flip the property. So that's why the 10% interest didn't bother you that much, because getting that from the seller just makes everything go through closing very simply, and you're not going to be holding on to this 10% loan for that long a time. You want to flip the property and approach an IRA account holder to borrow the money. They have $10,000 in their self-directed IRA and they decide it's a good deal. Structure. You borrow the $10,000 from the IRA account as a second mortgage at 15% and 0 points. You will make monthly payments of interest only for 6 months, then full repayment is due. Now remember, you're dealing personally with someone else's IRA account. So the procedure and documents would be the IRA account holder directs their custodian to send $1,000 to the closing attorney. The attorney prepares a second mortgage and note, monthly payments of $125 with a balloon at the end of 6 months in the amount of $10,125. Okay. If the loan goes a full 6 months, there's $750 paid to the IRA, but the seller gets $2,250 on their 10% note. So you've had to pay out $3,000 in interest to the first and second mortgage. The high rate, of course, the 15%, again, is held for a short period of time. So it's not that bad. And it's given it the high rate to attract the person to sell and to the second mortgage IRA to hold that position. All right, so building your list. Now I started doing self-directed IRAs back in the late 1980s. And I used to talk at that time about giving someone 15%. And after a few non-real estate investors that I knew had money put aside in retirement accounts told me that that sounded like a high rate of return and it must be high risk, I changed the way that I approached those people. I saved interest when I began asking, what interest rate would you be happy with? So I might ask a school teacher that has worked for years and put away a good bit in an IRA, what she would be happy with, what rate would she be happy with? And for instance, back in the late 1980s, she might say 6%. And I would immediately say, well, what if I could get you 7%? So that was a little better than what she said she wanted and she'd be happy with, but it was also not so high that she thought it was risky. So I would encourage her to let's do a deal if I had something coming up. So I'll put those people, as I collect the names and numbers, contact information, on a list of investors according to their interest requirements and funds that they have available at that time. Of course, when a deal comes up, you got to check those people. But I tell people that I go from the people that offer me the lowest interest rate and have the amount of money that I need, and I'll go on down to the higher interest rate people. And I had people at that time that said, well, I'll do 50,000 at 5% or 6%, but then I'll do another 50,000 if you get the first 50,000 out at 8%. So they were kind of splitting up what they had and telling me what they would do in different situations. Don't make it complicated, but you do need to build your list so that you're not running around like a chicken with his head cut off when you do have a deal come up. You need to have a list of people to call. All right, here's a participating loan example. You found a house that when fixed up would be worth at least $80,000. You've been able to negotiate an all-cash purchase price of $50,000. The house needs $5,000 in fix-up for paint, carpet, and so forth. You want to flip the house and approach an IRA account holder to borrow the money. They decide it's a good deal, but want their IRA to share in the profits. This is similar to what Larissa gave as an example a little bit earlier. You agree to split profits 70-30 with their IRA. A participating loan note is drafted for the IRA to make you the loan at 5%. Remember, you're outside of the IRA. You're going to split with the account holder with their IRA. So a participating note is drafted for the IRA to make you the loan at 5% interest or 30% of the profits, whichever is greater. There will be no monthly payments until the property is sold. Results: when the property is sold, $17,000 net profit is realized on the sale. So 30% of that is $5,100 paid to the IRA, which leaves you with $11,900 in profit. All right. Here's a solo 401k investment. You find a good owner carryback note. Now we're talking about a discounted note here. And first mortgage at 6% face and can be purchased for $70,000. At this discounted price, the loan yields 10% on the investment. Right? You only have $10,000 in your solo 401k. Now remember, you found the note and mortgage, and we're talking about your solo 401k having $10,000 in it. But you know others that have the remainder needed in or outside of their retirement accounts. Don't ever forget that the people could have their investment outside of a retirement account as well. You have your solo 401k partner with another retirement plan to come up with the $70,000 needed to buy the note and mortgage. You use your solo 401k to collect payments each month, and in turn, it cuts a check to the other account for their 8%. Now, how can you do this? Well, if you choose when you set up your solo 401k to be both the administrator and trustee, you can then open a local bank account to actually hold the funds. And so therefore you have a checkbook, you can collect the whole amount in and then pay out to the other investor as payments come in. It cuts a check to the other account for their 8%. The residual in your 401k represents an annual yield of 32.2%. Not bad with just a little bit of investment out. Here's an option example. You have found a house that when fixed up will be worth at least $80,000 as a flipper. You have been able to negotiate an all-cash purchase price of $50,000. The house needs $5,000 to fix up for paint, carpet, and so forth. You only have $2,000 in your self-directed IRA, and know that if you quick turn this house in your IRA, you could have unrelated business income taxes. Remember, unrelated business income taxes can be as high as 37% after you approach and pass $12,950 this year. And that changes a little bit with tax brackets every year, but it's the trust and estate tax bracket is what you're looking at. You know others that have money to lend. You show the deal to a couple and one commits $54,000 at 12% interest only, no points, no monthly payments, and a balloon in 6 months. This money can be personal funds or in an IRA or solo 401k. You then get an investor friend, not you, but an investor friend, to purchase the house in his corporation using your lender's money, along with $1,000 from your IRA. That's why you're not involved in this personally, it's your IRA. You may have found all this, but you have someone else actually buy the property. This $1,000 will be for an option for your IRA to purchase the house for $60,000. Results for your IRA. Your friend investor lists the property and gets a third-party buyer who wants to buy the house for $80,000, but your IRA has an option. It is agreed that your IRA will cancel the option for a return of your option money, which is $1,000, plus $15,000 in return. Therefore, your IRA invested $1,000 and in 6 months got a return of $16,000. That's a 3,200% annualized return. Now remember, don't get hung up on the percentage returns. That's just an efficiency measure for how fast money changes, comes in. So look at the dollars that you actually earn, which is quite significant. All right. Here's a profit sharing example. This is with the profit sharing without ownership. Again, you find a rental property that can be bought and rehabbed for approximately 70% of its fixed up value. You will oversee any fix up. You will manage the property. You want to hold long term, but this can work for short term as well. Sorry, Larissa, I'm having a problem getting it to move.
Oh, no, that's okay.
Right. So the structure, the solo 401k of the lender gets 8% base return on its invested capital and participates in a 50-50 split of the net rent and eventual sale proceeds. Now, a big caution on this. This structure will almost always invariably be a good deal for you as the investor partner. But as time frame extends, the lender's returns shrink, and they can shrink significantly. That is the reason for the base rate. So if you are the lender from your retirement plan, make sure that if you do any profit sharing, you have that base rate. Larissa's example had the base rate of 5%. That just means that's the worst return that the lender's retirement plan is going to have. The best is if the property is only hold a relatively short time and it gets a good split of the profits. All right. Now, normally you're going to structure a property such that there's an entity such as a single member LLC that is the actual owner of the property, and you're a member of the single member LLC. Now, why the single member LLC? It gives a liability protection to you by segregating the liabilities of the property away from you and your assets. So there's a liability shield that's provided by the single member LLC from the ownership of property of the property. The single member LLC is also transparent for tax purposes. So as far as your personal tax return, you're going to put any income on that personal tax return. This is where you're using someone else's retirement plan. So the single member LLC borrows from the solo 401k or IRA. In this case, it was a solo 401k. It gives a mortgage. It gets a mortgage from you representing the single member LLC, or if there's a manager for that single member LLC, the manager signs the note and the mortgage that goes back to the solo 401k. So this is typical structure. Nothing really out of the ordinary. We just have a retirement plan involved. All right, Jack's deal. Jack owned a couple of rental properties and had become proficient in management. Through a mutual friend, he learned of Sally, who had just retired from a very successful career and had a very large 401k. Jack met Sally and showed her that what he was doing with real estate, and she agreed to fund a couple of purchases for 7.5% return. Jack educated Sally on using money from her 401k for the loans to defer taxes on the interest and suggested a couple of true self-directed IRA custodians such as Advanta, where she could set up an IRA into which she could transfer a portion of her 401k. After he had proven himself to be a good payer and manager over time, Sally funded more deals. Now, Jack keeps more than $1 million of Sally's retirement funds working at 7.5% secured by real estate. And this is something that I've seen going on now for the last almost 15 years with a friend of mine, a financial friend of mine, who met a lady that had a large 401k account. 7.5% sounds like a lot in a low interest rate environment, but it's really not that bad when you make good deals and you can get money very quickly. In this case, Jack can get the money typically within 2 to 3 days if he has to move that fast from Sally. All right, now here's a interesting case study that I think you might be interested in. Here were two properties that I was offered. One was already had a mortgage, and the seller was willing to do a subject to deal with institutional financing in place as a first mortgage. And the other property had owner financing already negotiated on it when it was offered to me. And I thought about this and thought that, okay, these would be good things to put in my IRA, but it could have been done a little differently. It just happened to be, in this case, my IRA. It could have been someone else's. I could have been the one selling these. All right, so what we could do is get deeds into my IRA, and which the custodian would be controlling the IRA. But we got an issue here of liability because the properties are owned directly by the IRA. So if there's a liability on the property, it could extend to other assets I have in that same IRA. Also, there's unrelated business income tax because notice we got mortgages on both properties. Subject to will be non-recourse because I'm not signing personally on that note. And the owner financing would say specifically that it's non-recourse. And management. Obviously, properties owned by your IRA have to be managed somehow. And you could manage them yourself as long as you're not providing too much in the form of services. to the IRA. Let's look at that same situation if we did it a little bit differently. What if we had it deeded into a single member LLC that's owned by your IRA? That would be good. We've solved one issue out of the three, and that's the liability. But we haven't solved the unrelated business income tax and the management. Here's how it actually went together. I had a financial friend of mine form a single member LLC, which is transparent for tax purposes, and both properties were deeded to that single member LLC. Now, I should say this financial friend had crews that can go in and fix up the house, and he ran a little management company concern that could do the management for the properties as well. So my IRA then made a loan on a participating basis, but it could have been a loan with an option. Either way would have worked, to the single member LLCs for the purpose of buying the two properties and doing fix up on the two properties. And in order to secure that loan to the single member LLC, I got a second mortgage on each one of the properties to the IRA until the loans were paid off. So the issues, the liability, unrelated business income tax, and management were all solved by using this structure. And the reason I wanted to show this structure, which is a little outside of what we're discussing, I wanted to show there's a number of ways that you can handle deals like this. And which you choose is going to be up to you to structure it in the best way to reduce liabilities, try to avoid unrelated business income tax if possible, or if you are going to pay unrelated business income tax, make sure it's going to be a good enough deal to justify that. And of course, handling management could be a management company if you don't want to manage yourself. Okay, so action plan: get experience investing in real estate. Learn the IRA rules, very important. Approach others about using their IRAs and solo 401ks to loan money to you for your projects. Build a list that you can keep. Make sure their retirement plans are well secured. Build a reputation of honesty and integrity. That will go a long way in getting additional investors involved, and maybe even more money from the investor that you start with, from them or their family. And finally, underpromise and overperform. So I hope these examples, which are real life examples, but I've changed the numbers just to make them easy to understand so you didn't get hung up in the numbers. I hope these give you some good ideas of how to use other people's investments. And finally, we have done a amassing tax-free wealth using self-directed IRAs class for the last 20 years. I just realized last week it has been 20 years. But Pete Fortunato and I do this together, and we've got it scheduled for March 28th and 29th here in Atlanta. And we would love to have anyone attend that can. And you can find more information at assets101.com. Thank you, Larissa.
Yeah, absolutely. And I'm going to give everybody just another minute or two. So if you have questions, make sure you type them into the question box, and we'll make sure that we get them answered. But, you know, Dyches really mentioned this sort of in the middle of the webinar as well. But, you know, keep in mind, you're going to learn when you attend classes, you're going to learn deal structuring, but you're also going to meet like-minded individuals, some new investors, some seasoned investors. And as Pete always says, investing is a team sport. So if you're just getting started or you're looking to really learn from other people, this is a great opportunity. Dyches and Pete are going to talk about more deal structuring that they've done with self-directed retirement accounts, and it's very important. Of course, learning the rules, and then also networking. And I know I'm going to be there networking, so that I hope that you will join us for that. And then Dyches has a few other classes coming up too. Is it private lending after
private lending
self-directed IRAs?
Yeah, and
Okay.
that private lending will be your personal money or money that you have in your solo 401k or IRA.
Awesome, awesome. So I didn't see other questions. I did have somebody ask, what is the percentage of UBIT? And I know it varies, but you want to explain a little bit about that, Dyches?
The tax, is that what they're asking?
Yeah, what is the percentage rate?
Yeah, they can just go on Google and Google trust tax rates, trust and estate tax rates, and the tax brackets go from 0 up to 37%. Same tax brackets you have as an individual, except they're compressed. The 37% starts at $12,950. And below $12,950, you have the regular brackets, the 32, the whatever, 22%, so on down to 0. And you have a $1,000 exemption each year. So if the amount, once it's calculated for as net return based on the financing, is over $1,000, then you have to file and pay. And by the way, the tax is paid from the retirement plan, not from you as an individual. And one thing I should say, if you do a business in your IRA or 401k, you're going to have unrelated business income tax on all the profit, whether you've got any financing on the property or not. And then if you do an investment property, then it's based on the financing. And if you have personal property, then it's all the personal property you rented out that's subject to the unrelated business income tax.
And then I had another question pop up about unrelated business income tax. Just really asking you to give a little bit more of an idea on how to avoid it. So I think in one of the deals, you really sort of show how you could have incurred UBIT by buying property with financing, but then you restructured the deal so that you could avoid UBIT. So maybe just give us that definition again of where the UBIT comes from when there's financing.
Right. You got, well, the UBIT with financing comes from any profits that are made on the financed assets. So if you have a rental property, say, that's got financing in your IRA, either traditional or Roth, then let's say it's 50% loan to value when you purchase it. Then after you subtract all the expenses for the year, and depreciation is also allowed from the income. If you have $1,000 or more in income, and that can be a combination of several properties, then you have to file the unrelated business taxable income return, which is the 990T. And that's a little more involved. There are several people out there that will do the 990T for you. John Heyer is a tax attorney. I know his office has started doing those for people. And Larissa, do y'all have someone that y'all refer people to do that?
So I do refer to John Heyer for that. I
Okay.
just don't know enough CPAs and tax professionals that are comfortable with that calculation. So yeah,
Right.
I refer to John Heyer for that.
Okay, good.
I had another question pop up here on how would you present the idea of having somebody lend retirement funds? To be exact, the listener asked, how do you get them to buy into lending you their IRA funds?
Well, one of the best things you can do is to make a little 3-ring binder up of deals that you've done, both with money inside and outside the IRA. So what you first need to convince them of is that you have knowledge and you know what you're doing and you can make a profit. The fact that the money comes from their personal bank account or from the IRA or solo 401k is not going to be really the issue. They need to know that you are investable. You're a person that's going to do what you say you're going to do and have done it in the past. So that book of deals will be very helpful. And Pete has, when he was starting out back in the 60s, he put that book together, and he had actual letters from buyers, sellers, from other lenders saying how well he paid and how he took care of the property and so forth. So when the self-directed IRAs came along, he had something to actually start with if he wanted to.
Perfect. And then, we had a listener ask about the class. Are you going to cover solo 401ks in detail?
We will cover a lot of solo 401ks because the rules overlap between the two, and we'll talk about the times when the solo 401k might be a little different from the IRA. This is primarily a self-directed IRA class, but because the 401k is so similar, we will be discussing it as well. And I think Dorsey is even planning to do her solo 401k presentation based on the book that we wrote together along with John Hire.
Awesome. We had a question from a licensed real estate agent. She's asking if she can make commission from selling a property. From selling a property in my IRA, and I'm going to answer that one. The answer is no. Just keep in mind that when you're talking about IRS rules, they kind of cover a lot of things by saying you can't have a current benefit from an IRA-owned asset. And so if you're selling a property in your IRA, you shouldn't be providing those services or earning a commission for doing so. And so certainly you probably have real estate agent friends that can help you with this, and that you can work with them on that, but keeping in mind, again, no current benefit from an IRA-owned asset.
That's exactly right.
Let's see, I think we had a couple more questions here, and I'm going to take just a few more, but I like to always be mindful of everybody's time. And so if you have more questions, please feel free to reach out to us offline. But let me see here. When considering any of these options in an IRA, Roth IRA, the same withdrawal rates are going to be in place when I get to the age of taking distributions. And the answer to that, of course, is yes. These are retirement accounts just like any other, and so IRS rules apply. When you are earning, especially in a Roth IRA, of course, it's growing tax-free as long as two rules are true. You have to have the account for 5 years. It has to age for 5 years. And you also have to reach the age of 59 and a half. So those are Roth IRA rules in order for the IRA to distribute tax-free. And then at the time of the distribution, it would distribute tax-free. If you have a pre-tax account, of course, and you reach the age of 59 and a half, there's no longer a 10% penalty for those distributions, but they are going to be considered earnings to you. So you're going to get a 1099 when you take a distribution. So those rules are true no matter what you're invested in with your retirement account. Let's see. I had another question that said you don't hold securities at Advanta. Is there a way to open an account with Schwab or E-Trade and invest in securities in between real estate deals? And that's a great question. And the answer is, remember that this is not an all or nothing strategy. And so you can certainly have an IRA account with Advanta, and then at a brokerage firm elsewhere, you can transfer between IRA accounts as often and whenever you like. There are no tax penalties for doing so. I often have clients that are in between deals move back to their brokerage firm until they find that deal that they're ready to make again through their self-directed IRA. I did see some more questions pop up, but again, I'm going to go ahead and end the webinar, and I just encourage you guys to reach out to us with any questions that you have, just being mindful of everybody's time. If you want to go back and listen to the webinar again or share it, it has been recorded. We will share the link to the recording with you. That'll probably be done early next week. If you would like the slides, I did have a lot of people ask about the slides. We're happy to share them with you. Just make sure to reach out to me, send me an email, and I will make sure you get the slides. You can email me at lgreene@advantaira.com. And again, to register for the class and find out more information, go to assets101.com. Thank you so much, Dyches, for joining us.
Thank you, Larissa.